Alright, so as you guys should know, Target stock has been getting hammered, and Dividend Dude actually just made a video going over Target stock on his channel, and I thought it would be a fun new type of video to react to his video live. This is an extra upload, you guys. Please let me know in the comments what you think of this style of video, if you'd like to see more, etc. Thank you, and of course, roll the intro.
Hello, I like money.
All right, so every other day this week, Target has been going down 3 or 4%, and it's pretty much hit a new 52-week low for the last 2 months. So with this said, Dividend Dude has came to make a video, and I'm going to be reacting to it today. It's a quick Target stock analysis. I'll just be responding to my overall thoughts on the video. I thought it'd be a little bit of a fun bonus upload or whatever, you want to consider it. Toying around with this style of video. So if you like it, please let me know in the comment section. Make sure to subscribe already if you haven't. And let's get into this. This should be nice, juicy, and fun, if I'm being completely honest. I definitely will have some thoughts before we get into it. Of course, don't send any hate to Dividend Dudes channel or whatever. Go check it out. I'll leave all links in the description. So let's pull it up, and I'll give my live by live commentary action, some Jim Nance, Tony Romo stuff. All right, let's get into it.
Guys, welcome back to another video. In this video, we're going to be going over Target stock, Target Corporation, which has really struggled a lot recently.
Indeed.
Down another 3.5% today. This stock is at a all-time lows of 106.
All-time lows. All-time. I don't think all-time lows.
Dollars per share, which is absolutely insane to me. And we're going to be going over if we think this company is a buy now, based on current valuations, of course, and just because the stock is at an all-time low,
all-time low,
we're going to be looking at it 52-week lows and evaluating it economically and valuation-wise. So if we're looking at this company right now, it's trading, has a market cap of $51 billion right now, PE of 15, a forward PE of 15 as well.
All right,
free cash flow yield of 3.3%, which is slightly.
Stop right there. Right now is not the ideal time to be using free cash flow yield, considering they're, at a very low time. So I would not really look into the free cash flow yield at the current time. If you're going to look at the free cash flow yield, I would do 5 or 10 year average for that. If you're looking at free cash flow metrics, especially right now,
lower than the S&P 500 average, and a dividend yield of 4%.
That's crazy.
With a very large debt position compared to that cash.
There we go. We're going to stop it again there. The debt is mainly from short-term store net leases. So I would not look too deep into that. And retailers also historically carry much more debt. But I'm not very concerned with their debt whatsoever. It takes not that much time to do much research when it comes to the source of the debt. A lot of it's store leases, so I wouldn't be too concerned with that. Big positive thing too is the 59.26% payout ratio. That's a big thing that people, somehow don't seem to look at. The free cash flow payout ratio is going to be much higher right now, obviously, because look at their free cash flow for last year at least.
Position with not very good margins either.
See, we need to talk about that. Not very. What do you expect from Target? I could pull up Target's, historical Target's profit margins 2021. It's during the great time. 23.6%. Yeah. So I mean, historically they're much higher. So, and retail, I mean, what are you expecting, particularly for retail? You need to look at it, from outside perspective, because obviously those profit margins aren't crazy, but you're looking at a retail company. So, all right, we'll move on.
But if we take a look at their stock price, year to date, they're down 30%.
Indeed.
In the last year, they're also down 30%. Last 5 years, up 24%. Last 10 years, up 68%. And
that's just price return, guys. There's total return too, and they do pay a pretty, a reckonable dividend, we'll say. So, I mean, we got it. Of course, this isn't related to the video, but long term, it's a long term game, guys. These are tiny blips here. I'm sure during this time here in 2017, everybody thought Target sucked. Look, it's a long-term game, fellas. You got to keep that in mind.
Would have invested in them right when they started, obviously it would be up a lot, but they're down a lot year to date. So if we look at their annual revenue, let's take a look at the last 10 years. They've been growing revenues at about 8% per year, which is solid top-line revenue growth.
Very good revenue growth.
Been kind of stagnant recently.
It is not stagnant. Well, part of that is stagnant. That is growth. Visa's probably the same right there. When it comes to revenue growth, look at that. Well, I mean, not the percentages itself, but that's good revenue growth. But obviously, revenue is not everything, free cash flow. But I think the big thing with revenue, they aren't slowing down when it comes to sales and how much they're selling. I feel like that's a big misconception. Like everybody thinks Target, sucks. They're going out of business or whatever. Big thing there. Keep in mind their stores are not going out of business yet,
but still growing their revenues.
Yep.
If we look at their EBITDA, which is basically their pure earnings, we see a different story. A very stagnant revenues, maybe even decreasing their earnings.
No.
Stagnant
since 2018, 2019, take a bit of a dip. Yeah, I guess you could make the case there, but equity. Yeah, I mean, they're historically high in debt, so I wouldn't look very deep into EBITDA, but, pretty flat. Not ideally what you want to see. And I mean, but at the same time, you got to imagine if you were doing this video 1 year ago in 2022, all the everything, 1 year would have been much higher. It's a long-term game, fellas. That's what I'll say.
Revenues, maybe even decreasing their earnings. And let's take a look at my favorite metric, which is that free cash flow.
Right,
if we look at their free cash flow on this chart, we can see it's took a big dip in 2023.
Indeed.
And we could blame this on multiple things. We could blame it on the theft.
Theft was only $500 million, which I mean is a lot of it at the same time, but it's not the whole reason for it. The main reason for the big free cash flow decline was the inventory they overdid in 2022. Hopefully they learned from it. I really do. When you have a huge pop, as it happened in 2021 with the inflation and the stimulus checks, everybody's shopping there. They think they have much higher demand than they actually do. They go way higher in inventory, and they overstocked, and they lost a whole lot of money due to that. That was the big reason. I would assume that the free cash flow, huge decline this year at least. Hoping in 2024 they can get it back on track, $3, $4, $5 billion. I'd be very satisfied with that. But that's the huge reason I think it's being discounted right now too. The stock market right now does not like companies that carry a lot of debt and companies that are not positive in the free cash flow department. I would not consider Target a free cash flow negative company. Speaking from a long-term perspective, of course, right now they're obviously negative, but if you look at it quarterly, I could pull it up. They're actually rebounding quite nicely when it comes to the free cash flow department of things. And of course, we're going to pull it up on dividenddata.com, which is the sponsor of today's video. Check out dividenddata.com for 2 weeks, free without charge today. Check your portfolio, research stocks. It would typically take you an hour, but I can do it under 5 minutes. It's as easy as this, guys. All right, going into the free cash flow department of things, we'll look at quarterly, and you can see they're already making recoveries. January, they have very good free cash flow. So, you're going to see in a lot of charts. 2023, they're negative in free cash flow. Well, you got to look at the quarterly. A lot of data sites don't have, which is why I love dividenddata.com too. A lot of data sites don't have the quarterly free cash flow, so you're going to see stuff like that. That negative $1.1 billion for 2023. Important to keep in mind, it's a quarter-to-quarter thing, and we'll continue with the video.
The shrinkage.
Shrinkage, theft, basically same thing.
They've been on the culture wars that they've been dealing with.
No. The culture wars is not what has declined their free cash flow. No. This is the inventory.
With 3 different things that we could blame it on, right?
Inventory is 90% of that. Actually, no, I lied. Inventory 75% of that. The theft and shrinkage is by 25%, and those are all very justly could be justified as short-term issues. So if you're very optimistic for the long term like me, now could be potentially a decent time to enter in.
But let's take a look into this a little further. This is probably due to theft, due to shrinkage, due to culture wars.
Not culture wars.
And maybe due to the tighter.
If it were the culture wars, you're going to see a crazy decline in revenue, which, no.
Economic policies making people not want to shop at Target anymore. If we look at the stock-based compensation, it's not significant.
This is why you guys got to always look at earnings reports and stuff. Their in-store volume is, increased actually last quarter. So boycotts. I don't know if they consider the boycotters that are going in and messing with the tuck-friendly clothing store volume. I don't know, but
that isn't the problem. Let's look at the last 10 years. The stock-based compensation isn't the problem.
And some doof made a comment that they're paying themselves, or the CEOs paying them himself all back in stock-based compensation, which is eating away at returns, which is such a stupid comment to make. We just had to throw that in.
If we adjust for stock-based compensation, we don't see a problem yet.
Nope.
And if we adjust for per share, we don't see a problem either. So it's literally just that they're losing free cash flow.
Indeed.
They bled $1.5 billion last year. So this would be a recovery play because the stock price,
I can agree with that,
has followed the economics. The economics have gotten worse and the stock price has dipped.
No.
And rightfully so, right? So
that's not
you're gonna be
stock prices follow the econ. I guess, but like what warrants, I don't think a 1 year blip in the free cash flow warrants like a 50 or whatever the sell-off's been at this point. I just don't believe that a 1 year inventory oversupply has justified that. They've obviously dealt with a whole bunch of other stuff, but a lot of it's, I would consider the dip from 200, wherever they were at, like 200 to 150. I would consider that the dip due to the over inventory and the free cash flow struggles they'd have. Keep in mind, they increased their dividend 20% a month after that happened. So, and they bought back shares. I believe the selling off to this point has all been politics and people fearful of their free cash flow being in the negative for now, at least, and the net debt that they have to the leases.
Asking for a recovery play on this company. If we're going to their cash and debt positions, we could look over the last 10 years. Again, their debt has only increased and their cash position has depleted. So not look.
Yes, proves my point.
Last 10 years.
I don't think Target people were selling off Target. Nothing has changed when it comes to, keep in mind, this is the same debt that they had in 2021 when the stock was at $250 and it's only gone up by $18 billion, which you could justify to, opening new stores. And I would assume that debt to actually go down. I would assume that debt to go down too, as they are closing some stores and they're paying back debt. From what I remember on the last earnings report that I read,
their debt has only increased and their cash position has depleted. So not looking good in that department. And if we look at their dividends let's take a look over the last 10 years, they've made faster dividend hikes 3 years ago, and then very slow from 2022 to 2023, a very, very slow dividend hike.
All right. This is the thing. There are going to be years where there are dividend hikes of 0.8%, and there are going to be years of dividend hikes that are 20%. The goal is, over time, you buy in during the low times, and those dividend payments, and the hikes at least, your yield on cost goes up, and your dividend hikes average out above inflation. I'm hoping with the prices that I'm getting at today and Target continues growing their business, I can get an average dividend growth rate of 8 to 12% annually. I think that's very doable. 8% probably more likely, I'd say.
Of only 2%.
And keep it, this is like, they could have easily hiked their dividend like 10% last quarter too, guys. You guys don't understand. They got to do the right thing responsibly for the company. Like, sure, they could have, looking at their, payout ratio and all the other metrics, they could have paid out, another 10% dividend. Would it have been very good? Would people have probably sold out of the company? Yeah. But, responsible things, guys. This is what, it does not matter short term what the company does with the dividend is averaged out. Some years are going to be bad in the stock market. Some years are going to be bad for dividend hikes. It all averages out.
You look at their shares outstanding, they're doing good in that department. Buying back shares at quite a fast rate, which you want to.
Unfortunately, they didn't buy back last quarter. I'm really hopeful that this quarter they do. Especially with them trading at a really cheap price. I'd love to see them allocate, dividend hike money potentially towards, buybacks right now. But if they were buying it back at 150, I'd hope they continue to buy back at, these prices.
Let's see, your interest in the company accruing 3% per year on average.
That's very good, though. That's a positive.
If we look at their return on capital employed, which is one of my favorite metrics, when we look over the last 10 years,
obviously it declined.
I like to see return on capital employed above 12 to 15%. 12 to 15% on the return on capital employed
number
is the average of S&P 500 companies. So I want to see higher than that. And recently they've been achieving more, but in 2023, they have actually been below the average of return on capital.
That 0.7% really does it for you. It really does it for you.
Capital employed, meaning if you invested $100, you'll get $111 back annually. So the return on capital.
Wait a minute. No. Wait.
You'll get $111. The average of return on capital employed, meaning if you invested $100, you'll get $111 back.
Oh, no, that is not. No. It means you get an 11% return on the capital that the company invests back in their own expenditures
annually.
Oh.
So their return on capital employed has not been the best recently. Like I said
like
before, this is a recovery play.
About,
and even if we look at their historic valuation on price to earnings, it has actually risen because their free cash flow has decreased.
Obviously.
So overall, this company's economics have worsened, and we're asking the question if they can recover.
I just don't think you can say that they've worsened if it's only been over a 1.5 year period. I'd like to 3 to 5 years, to actually say if a company's economics have seriously worsened.
It's not that their economics are getting better and better. It's that their economics have worsened from 2022 to 2023.
Yeah, that's a 1.5 years. I don't think you can judge a business based off a 1.5 years performance. It's a long game. I get it.
And we're asking the question if they can recover from those lows. If we're looking at their stock valuation, we're looking at Graham's valuation right now.
All right, I'll say this with Graham's valuation, it's the most conservative valuation metric. If shameless plug here, but dividenddata.com, it has the 3 valuation metrics. It's Graham's valuation, dividend discount model, and discounted free cash flow model. And I typically lean towards the dividend discount model and mainly the free cash flow model. Mainly the free cash flow model, though. Graham's valuation is very, very conservative when it comes to this, so I would not buy too deep, and I've said this in my analysis videos.
Predicting a 5% growth rate in their earnings with the current yield on corporate bonds, it would give them an intrinsic value of $68.70, which is...
I don't know about that 5% growth rate. P of the company with no growth. I don't know about 5% growth rate for total return. I don't know about that.
Very, very low, but usually Graham's valuation tends to be more conservative. Let's take a look at that dividend discount model.
There we go.
Where we plug in the past dividends, get their average growth rate.
I would assume the average dividend growth rate to be 8% over the next 30, 40 years. That's just my guesstimate. Some years it's going to be higher, some years it's lower. This is what I'm saying. I also got comments talking about my analysis on Target. You can look at any other finance channel that's done a Target video in the last year or two. It's all dividend discount model and cash flow model in these same ballpark ranges. And you can see
predict conservative growth rate of 6% with the worst economics and the high dividend that they're paying. And we got a DDM
I'll say this, and this is probably against Target here. I wouldn't look too deep into the dividend discount model because they had a crazy couple of years of dividend growth. But I would assume if you average it down 8-10%, where they could be in the next few years, it'd probably be 130, 140.
Price of $155 based on that 6% growth rate. If we look at the multiples valuation, we plug in some other retailers who have also been dealing with shrinkage. Dollar General, a big one that's been dealing with a lot of shrinkage, struggling arguably more than Target right now. And we get a stock price on multiples based on $181, which is a very, very high stock price compared to the current price, showing upside of almost 100%. We look at that DCF model. We plug in their past DCF.
There we go. This is a DCF model that I'd love to use.
20%. I plugged in a growth rate of 5% because of their economics worsening. And this is showing 2022, not 2023 as the last one. So I'm plugging in a way more conservative DCF price. And we're getting their debt. We're getting that total equity value and dividing it by that shares outstanding. Get a DCF price of $194, which is actually a very fair DCF price. And right now we have an intrinsic value of this company of $150 a share.
I feel like I've seen this sheet before from another channel.
Representing a lot of upside on that current share price. And if we want a 10% margin of safety, you want to buy at $135 a share. But for me, I think I would actually look for a 20 or 30% margin of safety. If you want a 20%, you want to buy at 120. And if you want a 30%, you want to buy at 105. So you would actually not buy right now. But I would actually look for a 30% margin of safety with this company just because I think it's a little bit more of a risky play. So I would be looking to buy maybe under $100 a share, which does not hit that current valuation. But in terms of me looking to buy this company, I don't think I would ever buy Target.
All right, what difference is 5 or 6% going to make realistically when you're buying long term? It's $5 or $6. My bad. I'm no value investor.
Just because it doesn't meet the criteria that I look for when I invest in a company. But if you're looking for a short-term value play, it could be the right play for you.
I don't know.
Thank you guys for watching that video. That's my analysis.
Short-term value. I don't know. I don't know about short-term value. I don't think that's much of a short-term value play. I wouldn't consider Target much of a short-term with how they've been doing recently.
Target. I don't like it as a company the best, but you might like it and see opportunity in it.
Yeah.
If you like the video, then make sure to like, subscribe, comment, turn on that bell. Most of you guys who watch my videos aren't subscribed. We're on the way.
Yada, yada, yada. All right. I'm sorry to Dividend Dan for picking on you a little bit here, but go check out his channel, link in the description. Overall with Target, I've said this once and I'll say it again. Target is not the best retailer. Heard it here first. I think it is a good retailer that will grow with the American economy. And at these prices, I believe I'm not only going to get a really good dividend yield on cost, I'm going to secure some decent dividend growth in the future, 8 to 12%, I believe, annually I can get. And I think I'm going to get a market-beating return at these prices long term. This is not a short-term company you guys want to be investing in, guys. There could be next couple of years could be bad for it. I'll be honest, but we're going to continue sticking to your original investment thesis. That's what you guys got to do. Yeah, no comments. I said that. I told Dan, tried it out to make the video with any bias kind of as a joke. And, he was 60%, leaning against Target, but it's okay. Thank you again to Dan for allowing me to go over the video. Link in the description for everything. Thank you guys. And, of course, do dividend stocks, not drugs. Have a good one.